Welcome to Money and Planet, the channel where sustainable investing meets the future economy, and where money finally learns it lives on a planet. Today we're asking a spicy question. What happens if the US dollar stops being the world's reserve currency? Spoiler alert, it's not Mad Max, but it's also not free refills forever. If you think this topic sounds boring, relax. We're about to compare America to the British Empire after it peaked. Stay until the end, because we'll also talk about who might replace the dollar. And no, it's not your favorite meme coin. If you're new here, welcome. Money and Planet breaks down big financial shifts, sustainable investing, and the future economy without putting you to sleep or selling you a miracle course. We study history, zoom out to planetary scale, and then zoom right back into your wallet. If that sounds useful, you're in the right place. Let's start with number 1, higher inflation. When a currency is the world's reserve, everyone needs it. When everyone needs it, demand stays strong. When demand weakens, prices at home start acting funny. If the dollar lost reserve status, imports would get more expensive. Energy, electronics, raw materials, and all the stuff hiding inside your stuff would cost more. Britain learned this the hard way after World War II. When the pound lost its throne, imports got pricier, rationing lasted longer, and tea became a patriotic act of resilience rather than a lifestyle choice. Number 2, higher interest rates. Reserve currencies get a cheat code. They borrow cheap. The US government can issue debt and the world lines up to buy it. Lose that privilege and suddenly lenders want higher returns. Translation for normal humans. Mortgages, car loans, student debt, and credit cards all get more expensive. Britain saw this as well. After the pound faded, borrowing costs rose, investment slowed, and the country had to accept help from the IMF in the 1970s. Yes, Britain once needed a bailout. History has receipts, and they are awkward. Number 3, government budget pressure. A reserve currency lets a country run deficits without immediate consequences. Remove that status, and math becomes less forgiving. The US would face tougher choices. Cut spending, raise taxes, or inflate the problem away. None of these options win popularity contests. Britain responded with austerity, shrinking its global military role and rethinking its welfare state. Empire out, budgeting spreadsheets in, and suddenly national pride had to share space with fiscal reality. Number 4, a weaker job market in global finance. Wall Street benefits enormously from dollar dominance. So do multinational corporations headquartered in the US. If global trade starts happening in other currencies, some of that advantage fades. Jobs don't disappear overnight, but growth slows. London experienced this shift when financial gravity slowly moved toward New York. The city survived, but it had to reinvent itself as a services hub instead of the center of the monetary universe. Reinvention is possible, but it is rarely painless. Number 5, declining real household wealth. When your currency weakens, your purchasing power shrinks. Savings buy less. Fixed incomes fall behind inflation. Assets reprice. This doesn't mean everyone becomes poor, but it does mean the invisible escalator going up stops working. In Britain, the post-reserve era meant lower relative living standards compared to the rising American middle class. Same effort, different results, and fewer victory parades. Now here's the part most people miss. Losing reserve currency status is not a collapse. It's a long, slow adjustment. Britain didn't vanish. London didn't sink. The country remained wealthy, stable, and influential, just less dominant. The difference is psychological as much as financial. Expectations reset. The future feels tighter. The upside is that economies often become more disciplined, more export-focused, and sometimes more sustainable when they can't print their way out of problems forever. Constraints force creativity, and creativity can be productive. So who's next? Will it be the euro? Possibly, but Europe still lacks a unified fiscal authority and political cohesion. Will it be China's yuan? Maybe one day, but capital controls, demographics, and trust issues hold it back. A basket of currencies? Very likely. Digital settlement layers? Already happening quietly in the background. The future may be multipolar, boring, and more balanced, which historically is healthier for the planet. For investors, this means diversification matters more than ever. Assets tied to real productivity, sustainable resources, and resilient systems tend to age better than pure monetary privilege and paper dominance. If you enjoyed this breakdown, hit like, subscribe, and share it with someone who still thinks reserve currency status is permanent. It never is, and history loves reminders. Here's the philosophical takeaway. Money is not power, trust is. Reserve currencies rise when the world believes in the system behind them, the rule of law, the stability, and the future promise. They fade when belief shifts elsewhere. Sustainable investing is ultimately about aligning with long-term trust, not short-term dominance. Empires change, technologies change, incentives change. The planet keeps score anyway. Thanks for watching Money and Planet, where the future economy gets discussed before it becomes obvious, uncomfortable, and unavoidable.